Welcome back to another episode of the Educated Homebuyer Live. We appreciate you guys being here. Once again, we had another really slow week in housing data. Not really a lot to report other than existing home sales being up, 14.5%. The Fed raising the Fed funds rate, interest rates coming down. Can you think of anything else, Josh, that happened this past week that's worth noting?
No, the Fed was the fun one today.
So the Fed, let's talk about the Fed. So what did the Fed do today? How is that going to impact mortgage rates? How's that going to impact their future outlook with the changes in their statements? We're going to take a look at that. We're going to take a look at inventory like we always do, give you a little bit of update what's happening on the economy with inflation, with rates, and then we'll get into some questions and help you guys become educated home buyers. So, Josh, the big news, like you said, is the Fed. The Fed coming out today, raising the Fed funds rate by 0.25%. I don't think any of us were surprised at this point. Maybe a week ago, when there were some potential expectations that they may not raise at all. But they did come out. They hiked 0.25%. They changed some of the language in their statement. And in turn, that change in language in the statement, even though the dot plot map, if you will, whatever they're using there to show what each where each Fed member expects to be, didn't really change for the good or for the better. We actually saw a decline in interest rates. Interest rates improved quite a bit. So let's talk a little bit about that, why the Fed hiked and we actually saw a reduction in interest rates.
Absolutely. The interesting thing, Jeb, let's think in terms of the last 2 weeks before we had any banking problems. Fed came out super hawkish, super aggressive. Basically, the markets had priced in up to 70, 80% in terms of the likelihood of there being a 50 basis point hike.
Yep.
Then we have the banking issues come out, and you have some so-called experts, or at least talking heads on the TV, saying, no, they're going to cut a quarter. And then, oh, no, they're not going to do anything. Here we are, and we got the quarter. That was pretty much priced in, 86% expectations of a 0.25% hike. We got a 0.25% hike. We got about what we expected with their policy speech in the Q&A that Powell had afterwards. So bonds reacted well, and it's always sort of a little bit of time before we get the full reaction. There's always a knee jerk when they come out with the announcement. There's usually a correction while they're taking the Q&A, and then over the next day or so, it kind of shakes out and settles out. So, Jeb, tell me what your thoughts are on this. What I thought was most interesting is you look at the futures markets. The futures markets are projecting that we get cuts by the end of the year, and the Fed actually comes out and pushed out the cuts even further into 2024 in terms of their dot plot, which is what they publish as here's our expectations of what we think we're going to do going forward.
Yeah, I mean, it's there's such a big difference in the two that it's almost laughable to some extent, and it just shows you how no one really knows what's going to happen at the end of the day. I mean, we've talked a lot about it, Josh, in the idea that the Fed, regardless of what the big picture is here, and regardless of what happened 2 weeks ago with banks, the Fed, at least in their statements, have to remain somewhat hawkish because otherwise, if they let on to the markets that there's any chance that they're going to pivot sooner than originally thought, which they kind of let on a little bit today, but not really in Powell's language. If they did that too early, that they probably get a run on the markets, right? Stock market probably goes crazy. It might let inflation get back out of control too quickly before ever being wrangled back down. So I think that is part of it. I think, when the Fed, I forget the exact language. We should have posted it in one of the clips here, but where essentially like tighter restrictions going forward was one of the things versus ongoing hikes. It was something along the lines like they took out the idea of ongoing hikes and basically just said more restrictive policy going forward, with the idea that, hey, listen, there's a chance we might not hike, is the way the market took it. And we're, might be more restrictive on how we move further, which means maybe they just stay where they are versus seeing cuts in the short term. But regardless, it it was a positive sign for interest rates, which is what we saw happen today, right? So, Josh, I don't know if you want to talk about rates now or wait until after we go over some of the charts and dig into it.
Well, here, let's actually show that chart. Did you already pull it in? Let me try and get it to that one before we kick in. This is kind of interesting. So look at the candles. Again, a lot of this stuff, if you don't look at it regularly, it's not going to make sense or mean a whole lot. But what's good here is the big green candle is today. That's the recovery. But so say that's Wednesday. We go back Tuesday, Monday, Friday, Thursday, back to where we were last Wednesday. So Jeb's saying, hey, rates rallied. They improved nicely today. And I go and I refreshed my rates, and I have the slide from last week where I put in what all the rates were. And the first one I priced was literally my best price lender was the exact same price as a week ago. Well, this tells you why. We have hit that red line that I drew in there. We've hit that 1, 2, 3, 4, 5, 6 out of the last 8 trading days. That's an important level. When you keep hitting a ceiling and don't break through it, it becomes stronger and stronger resistance. The thing that I highlighted there, the top line, that is the 200-day moving average. We haven't been above the 200-day moving average in over 18 months. That is more of a long-term indicator. You'll see where we've gone above and below the 25, the 50, and even the 100 a couple times within that last 18 months. And those are more intermediate term indicators. We're getting really close. That 200-day is going to keep coming down. We're going to keep hitting this ceiling, and there's a very good chance that we break through it. Now, that doesn't mean that we just take off like a rocket. And remember, when I say take off, we want bond prices higher because that means yields and interest rates are lower. So what this tells us, we have a ton of volatility. So these long candles, whether it's a big green or red body or these long upper and lower wicks, every day we're seeing big ranges of what the market is doing. Yet at the end of all that, it's not really going anywhere. We're exactly where we were a week ago, but we traveled a lot of ground in between. So until we get more clarity, like what do we talk about, Jeb? We come here every week. The futures market says one thing. The Fed says one thing. The Fed has reasons for taking the action that they're taking, and they have reasons for saying what they're saying, even if they don't necessarily believe it. So I think it's going to continue through at least the second half of the year that we have a lot of uncertainty, a lot of questions, and therefore we'll have a lot of volatility while rates continue to trend better from where they, worsened to in October, November, and then hit again about 3 weeks ago.
Right. And one thing we'll touch on here just briefly is that, you saw existing home sales jump 14.5%. Why? Because you saw rates move lower in December and January, right? So as rates moved lower, more buyers came back to the market, and you saw that reflect in existing home prices. Now, something you also saw with that latest report is that year over year, the National Association of Realtors is reporting a small decline in the median home price. So if you're a buyer out there, is that something you should be concerned with? My thought is no. You're going to get different readings on the year over year on different models here. CoreLogic's going to come out with theirs, and just, each one's going to have their report, and all are going to be a little bit different. But when you hear that, Josh, what are your thoughts? Year over year decline in home price.
I don't care about median prices. I ignore
And
them.
why?
They overstate prices when home prices are going up, and they understate prices when they're level or coming down, or when affordability right now is strained. So looking at this, we had, what is the median price? The median price is not an average. It's telling you that half of homes sell for more than that price, half of homes sell for less than that price. So what are the numbers that we can look at that are valid and meaningful and useful numbers? Case-Shiller and the FHFA both have indexes that are paired sales indexes. They're not just taking the whole list of all the sales in the US for the last 30 days and saying, what was the midpoint? They're saying repeat sales, the same home, same 3-bedroom, 2-bath, same neighborhood over time, repeat selling more than one time. What does that do? So it gives you a much better indicator. Whereas over time, we may have people start buying bigger homes. Well, those prices are going to be higher, but the price per square foot isn't necessarily higher. When affordability gets strained, more people are going to gravitate towards lower priced homes. And that's what we're seeing. I was pulling up a number here. When you look at the breakdown in sales in that NAR report, increase in homes sold between the $0 to $100,000 price range and in the $100,000 to $250,000 price ranges, while less homes sold in the higher priced categories. So when you break it down, it tells you something. There's something going on there. So it's not that the report or the data is meaningless. It's that price, that median home price, is far less valuable than looking what's happening with those paired sales, repeat sales indexes. And what we've seen, that's moderating also. They're still showing year over year gains, but we're getting perilously close to flat year over year. And that's likely to continue going forward. We talk about it here every week. We don't have a recipe for rapid appreciation or much appreciation at all right now.
And let's talk about some of those reasons. So the first thing we're going to look at, as we always do each week, is inventory. So this is national inventory across the United States week over week. This week we increased by just over 2%. Actually, not quite 2%, but last week we were sitting at 412,000 homes nationwide. Today we're at 414. So a little bit of an increase here in Orange County. Inventory actually went down. Last week we were sitting higher than 2119. I don't remember the number, but it was in the 2100s. Huntington Beach, we were actually higher as well. I think closer to 149. So yes, inventory is increasing in some markets. Some markets it's not increasing quite as much. And here in Orange County, we're actually seeing it go the other direction. On top of that, why are we seeing inventory go down? Because we're not seeing new listings come to the market. That is the big problem, right? As you would imagine. But this gives you a really good chart to look at in comparing this year to the last 2 years with regards to new listings. Look at that huge decline coming into March. When if you look at the two charts above that, the two trend lines above that, you can actually see this is the time of the year where you typically see inventory jump. You always hear us talk about the spring selling season. This is the time when markets, homes start to come to the market. This year, we're seeing the opposite. But hopefully, if you go back and look at this chart here, we're starting to see some flattening out, a little bit of an increase in inventory. So maybe this is a trend going forward, and you're going to start to see some more properties come to the market. Because there's not a lot of property out there, you're actually seeing fewer pending sales, right? Less properties going into escrow. For one, affordability. Two, there's just less properties to choose from. Therefore, there's less people actually buying them. But you can see last year at 406,000 last year. Today we're 47,000 fewer than that. I mean, just look at that chart going down, not going the right direction. Next one, median price of homes in contract, about the same as it was this time last year, sitting around 375,000, which is flat year over year. Again, percentage of properties that are taking price reductions, again, pretty flat, sitting around 30%. Not really, still to be trending down just a little bit, but not by a huge amount at all. Why rates can't rise too much. So this is something Josh and I have talked about.
With this chart, they're specifically talking about Treasury yields. This isn't mortgage rates, but they move somewhat similarly in lockstep. I didn't mean to interrupt you, but I want to
No, it's good. But I mean, I put it on here more so to look at the interest on their debt service. I mean, just look at that line. It's incredible. And a lot of it has to do with, or pretty much all of it has to do with COVID relief to some form or fashion. It just shows you why rates can't continue to rise, because that debt service just gets more and more expensive.
Well,
Josh,
look at it, Jeb. So it went, what is that? A 10x multiple from 1.5 there at the bottom to 13.5 here in the near term future. So it's an 10x multiple there of debt service that our government has been paying. I don't know if all of you have been paying attention at home, but we have been running deficits for the better part of 50 years, with a few exceptions of 1 or 2 years in the late 90s. You were already running a deficit, and we just 10x'd, 8x'd the debt service on this. So I always said before, Jeb, one of my business partners, Scott Shang, he always said, well, rates have to normalize. They have to go up. And I said, well, if something can't be true, it won't be true. Our government can't afford this level of debt service. They will find a way to make it not happen. And what I missed, or what I didn't understand, is we literally have wizards in Washington, D.C. that do not understand that there's a lag in them spending shit tons of money. That's a technical term. And the bill coming due for that. So if you look,
there is no bill.
We talk a lot, Jeb, about the 10-year treasury, but there's 30-year treasuries. There's also 7 years, 5 years. There's 3-month treasuries. And a lot of that borrowing is out at 1 year, 3 years, 5 years. So you can borrow an awful lot in 21 and 22, and you have fixed that debt for the next 1 to 3 to 5 years. We are starting to see a lot of that roll over. So the 0.2% yield on a 90-day treasury became the 90 days probably 4% or 3.5%. And if you're looking at a 2-year treasury, it is vastly in excess of a 10-year. So what we are seeing is this coming home to roost, and now politicians are going to have to see it. We have this battle over, or we're going to raise the debt ceiling. Well, how about we stop talking about raising the debt ceiling every 2 years, and we come back and go, we can't just keep spending money indefinitely without this happening. No, 100%. 100% not as fun.
It's not as fun. With that said, we're going to hit another chart. But before we do, Jessica is saying, is your guys' Instagram down? Can't find it to tag you guys on IG. So we don't have, we have separate Instagram. So it's mine at Jeb Smith, and Josh's. What is yours, Josh? Do you have an Instagram?
Josh's is far less interesting. It's I have to step my Instagram game up. So Jessica, we don't need to worry about that for now.
So just at Jeb Smith. Anyhow, Josh, let's get into another chart here. Crude oil. Bottoming out.
This, one of the things that we've talked about, the wild card that Jeb and I, the smart people that we follow, are insisting that energy is not going to the moon, but it's going to be more expensive going forward. There's a finite supply of it, and demand is increasing globally, in addition to some of the political things that the U.S. government is doing to limit supply here in the U.S. But strangely, every time someone makes a really compelling argument that we're never going to see sub-$100 oil again, we see a chart like this. So I'm far above my pay grade to say one way or the other, but as long as you see numbers like this, if oil's under $80 a barrel, that is going to be helpful and supportive of inflation coming down. If we get well above 100, where we peaked up here around 120, some people were calling for $150 a barrel oil. If we see that, it will be problematic for inflation going forward. This one wanted to show the chart. It's real tempting to say, look at this peak and look at this hard yellow line coming down and inflation dropping. But really what we need to look at with this chart, the reason why the Fed is still acting, the reason why the Fed is still stressed out, is that big red dotted line there showing you the gap between where they are and where they want to be. So even though we've improved a ton down to 6%, that is literally 3 times what they want it to be. I mean, that's a sobering thought that we do have a long ways to go. Jeb, what I wanted to circle back, I didn't get this in there, but we saw something this morning that I had never heard this term before, and I thought it was quite interesting. Said the Fed is now starting to pay attention. We talk about the core inflation, core CPI, core PCE. It excludes food and energy because those things are volatile, and the Fed can't directly control them. So they shouldn't really be taking it into factoring it in when they're making their policy decisions, because their policy decisions are not going to change those things. Well, the new one that got thrown out this morning is the super core. So it strips out not just food and energy, but also shelter costs. And the first thing when I saw that, Jeb, I started thinking about it, and I go, it sounds like someone's just stripping out the things that they don't want to pay attention to, or that are taking the numbers in a direction that they don't want. Because when you strip that out, the super core right now is at 2.1%, right where the Fed wants it. So it would be tempting to say, hey, no problem, no worries. But there is benefit in this, because in 2020, 2021, 2022, when housing was running up and appreciating rapidly, the CPI and PCE figures were understating that. So if we had stripped it out, we probably would have had higher inflation readings, and it would have led the Fed to take away the punch bowl sooner. Yep. And looking at it now, it can give them some insights into, you've done some pretty aggressive tightening. Jeb, you and I were watching the Fed announcement together this morning, and they just started hiking last May. Like, it seems like it's been going on forever,
9 in a
but
row. Yeah.
it came fast and hard and heavy. So it seems like it's been going on forever, but it's only been 9 months. So when you look at how much they've tightened policy in such a short period of time, it doesn't take a wizard to realize that we probably haven't seen the impacts of it all. So we've seen that drop from 8% to 6%. We still need to get to 2%. So that's not to say, hey, the Fed should stop or the Fed should be cutting, but it would be prudent at some point in the near future to take a breath and say, let's see what happens over the next few
Yeah.
months and
I
see
mean,
if this continues to moderate.
yeah. And I know we're going to look at some other charts here, but I mean, employment alone, I mean, you definitely haven't seen the effects of that hit the economy yet. I mean, yeah, there's still good, I mean, solid employment out there, but the people that have been affected, like that hasn't hit the numbers, won't hit the numbers for some period of time. So those that are betting recession completely off the table, I would tell you to probably think again, because I think the likelihood of that is very, very high. Just it hasn't shown up in the data quite yet. But with that
Yeah.
said, Josh, I know you wanted to talk about what's this one?
This is just in relation to a question that we had last week. I don't know if it was Anya or someone else said, hey, with banks kind of getting
Oh,
themselves in
tightening.
trouble,
Yeah.
are they going to be tightening underwriting guidelines? It's going to be harder to get a mortgage. Take this chart with a grain of salt. It's a Federal Reserve Board senior loan officer survey, willingness to lend to consumers. I don't know what a senior loan officer is in this context. Most mortgage loan officers will add after they've been in the business for more than 90 days, will add senior loan
As soon as they
officer
get
to
their
their business
license,
card.
they're
Yes,
senior.
they're licensed, so now they're a senior loan officer. But the senior loan officer that throws it on their business card because they can doesn't make policy decision like this. So I honestly don't know who they're surveying, what they're talking to, because we've talked before, most loans are not portfolio loans. They're not done by community or regional banks. So they're not setting their own underwriting guidelines. 95% plus of all loans are being underwritten to Fannie, Freddie, FHA, VA, USDA guidelines. Those are not tightening. Those are not changing. Investors may lose their appetite for some of the crazier stuff. Like Jeb, we talk about here on the show that you can get an FHA loan with a 580 credit score. Maybe some lenders decide to stop doing that. I don't think it's the end of the world. It's tiny little, long tail volume that doesn't make up much of the market. But this is saying that someone is surveying someone who makes lending decisions, maybe not directly to mortgages, and they're saying we're going to be tighter going forward.
Nah, good stuff. So you want to do a quick update on rates where we sit today?
Yeah, let's take a look at it. Essentially, we are where we were last week. Your FHA, if it's standard balance, 0 points, minimal lender fees, somewhere around 5.625. You can get it lower. Normally, Jeb, you and I talk about not paying points. Points go go further than they normally do in the current market. Lenders would rather you take a lower note rate and pay for that versus the no point rate. So maybe you can get that down into the low fives on an FHA loan. Standard balance is going to be at about 1/8% higher. VA, for whatever reason, is a little bit higher right now, 5.75 or so with a 0 point on the standard balance and just over 6%. The VA high balance stuff is kind of throwing me off because usually it trends very tightly to the FHA high balance. But again, these are 0 points, minimal lender fees. APR is fairly close to what that note rate looks like. On the conventional side, again, you can get down into the low sixes without paying a ton of points, mid sixes with 0 points. It's still very difficult to get a lender credit. And the thing that I would say, like for us here in Southern California, I'm not doing very many high balance conventional Fannie Freddie high balance purchases because if that borrower can be squeezed into a jumbo program, the jumbo terms are much better than high balance rates for Fannie and Freddie. So you can get a jumbo loan in the 6.25 to 6.5 range, depending on what you're wanting to pay. And that high balance, absent a big 40-50% down payment, is going to be more like the high sixes, even with the improvement we've seen.
All right, good stuff. Afro Mex family gave us $5, so thank you for that. Much appreciated. Appreciate you being here. And I saw your comment earlier mentioning that you had bought or took advantage and refinanced back in 2020 at a rate of 2.25, and you won't trade that for nothing. And that is the reason that we are in this mess now, because people have those super low rates and they're not going to trade them for nothing. But on a separate topic. So a lot of you guys ask about mortgage insurance all the time. In fact, yesterday on the Educated Homebuyer podcast. Today on the Educated Homebuyer YouTube channel, you can actually go and listen to Josh and I do a 30-minute deep dive into mortgage insurance, essentially everything you need to know to get rid of mortgage insurance, why you have mortgage insurance, ways to shop for mortgage, everything. So go check it out. If you're not listening or watching us on the Educated Homebuyer podcast on YouTube, go check that out. We appreciate the love, the shared support here between my channel and that one would be awesome. And if you listen to podcasts outside of that, you can listen to the audio now on YouTube. They actually have a separate platform for podcast. It's on there, but it's also on Spotify and Apple if you prefer those places. So either way, we appreciate the support. So go check them out.
Jeb, the big benefit, I don't know how many subscribers they have, but the big benefit of the podcast feature in YouTube, if it's listed as a podcast, it strips out the audio and it publishes it to YouTube Music. So if you're a paid subscriber to YouTube Music or you use the free version of YouTube Music, you can get the podcasts there, not just us, any channel that has episodes that or videos that they call podcasts. You can check that out.
Awesome.
Wanted to point out, Jeb, we have a comment here. John Doe,
Yep.
Our friend Michael Zuber is very, very fast to publish. We recorded an episode with him on our show and us on his show yesterday, and his got published today. Really good content, really liked it. And I enjoyed the experience. I enjoyed our conversation. I think you guys will like it. But where I wanted to go with that, Jeb, what do we see? What are we bombarded with on YouTube every day? It's crash videos. It's crash porn. It's the easiest way to get views. So Michael pointed out something, or he stated something that we've talked about here on the show, but when he said it, it made all the sense in the world. And it says that we're looking at the wrong thing. All of the crash bros are talking about home prices are going to crash. You show us the charts every week, limited listing volume, sales volume down. So we've seen a cratering. We've already seen the crash. We had a crash in real estate volume, not the number of real estate sales, not home prices. And when you look at it that way, there's absolutely a logic to it. And people who otherwise are impervious to logic, who insist that home prices have to crash, not come down a little, not moderate, have to crash, hopefully they can see that and sort of understand that there's reasons why prices are related to the supply-demand balance. For you guys who are here every week, you probably get tired of hearing me and Jeb say that, but we can see.
Been saying it for 2 years, dude, since the beginning of COVID. I mean, so it's at 3 years now. Been preaching supply, demand.
And demand, there's no two ways about it, Jeb. You and I see every day, demand is way down. So people are saying, hey, demand is down, the prices have to come down. No, they don't, because people like the Afromex family have a 2.25% interest rate, and they say, I'm not giving it up for nothing.
Well, dude, it's like that. And like, just a quick note, I'm going to do a video on this soon, but man, I'm telling you, I'm calling every day from clients wanting to make offers on property. I've yet to make a phone call on a property that someone wanted to see that didn't have a ton of showings, offers already, like going above the asking price. It's just stupid. Like, because there's no inventory. Again, everybody is vying for the same piece of property. And so guess what? Like I said, a year ago, 2 years ago, when you got 10 people wanting one property and only one person gets it, that's still 9 buyers that are looking to buy. So when the next one comes up, guess what? You've got 9 people plus any additional people that didn't get their opportunity. That's here in Orange County, right? If you're in, and even Long Beach, I mean, because that's part of LA County. If you're in another area, you might not be experiencing this, right? You might be going, Jeb, you're crazy. Like, we got all the inventory in the world. I completely get it. That's why real estate's local. So just make sure you're following the right information in your market so that you're on top of it and can make the best offer for you in that market. But if you're local here, just know that, what we talk about day, week in and week out, it hasn't changed so much. Yes, demand is down, but it's still enough to create multiple offer situations. All right, Josh, what else should we do? Should we just, answer some questions or just keep talking?
I don't know how much more we have to say. Let's go to the questions.
No. Okay. Let's see. We'll just start with Christian. We don't have a lot of questions, guys. So we'll start with Christian, though. Christian says, do you guys feel like home prices will fall again next winter? And I know for the foreseeable future, will continue going up with the Fed. And I know rates, I assume, is what he's talking about. How will this impact more? Or I know, okay, you get what we're saying. He thinks the Fed funds rate is going to keep going up, wants to know how that's going to impact rates. So let's start with the first question. Josh, do you feel like home prices will continue to fall again in the winter?
I'll go back to what I've always said. We don't have a recipe for a lot of appreciation. What appreciation we will have will come from interest rates dropping and increasing affordability. And let's be realistic, even if rates went all the way back to 4%, it's not bringing affordability back to the levels that it was in 2019, 2020. So we're going to have a limited amount of buyers who can buy at these prices, or a depressed level from what we had earlier. Now, this was the $1 million question. One of the things that you and I and Michael discussed on that call yesterday is what level of interest rates brings people like the Afromex family back into the market and willing to sell. Not that they would, they just bought a couple of years ago in a 2.25% rate. They're probably not at any time soon. But let's say someone's lived in their home for 7 or 8 years. They've had 2, 3 kids since they moved into their small starter home, and they refinance to a 2.5% rate. What interest rate would they be willing to move? They're not willing to move at 6.5%. Mm-hmm. What rate are they willing to move at? And when they do that, what does it do? So let's say my number was 4.5. Was yours closer to 4, Jeb? Or was that
I said between 4.5 and 5 was my number.
Okay.
I thought you could have a little bit higher rate and still get some activity with people listing.
Yeah. And I agree with that. But to bring a volume of sellers into the market that have rates in the 3 to 3.5% range for the most part, I think we need to get to 4.5. Michael thought it was 4. Those are 3 educated guesses at 4, 4.5, and
so
5%.
It ranges between 4 and 5. And the reason, again, that I feel like, it's those that want to sell are going to have to give up something. In my opinion, if they're going to want to buy something, they're going to have to give up something, because the chances of rates coming back down where they were probably not going to happen. And so I figured if I got a rate at 3 and rates are currently at 6, if I can get somewhere close to the middle, that gives me enough relief to be able to make that move is the thought in my head. Now, what I'd like to do is ask you guys listening. There's 235 people listening right now. What rate do you think? Where do you think rates have to get? Put it in the comments for sellers to put their properties on the market to get more inventory, because ultimately what we need is that inventory coming to the market. So put it in the comments now, because I'd love to know what you guys think. You guys follow other channels other than us, and a lot of you guys have strong opinions, and so I think it's worth having the conversation there. But Josh, to follow up on the front part of that question, or the first question there, the one that I asked a moment ago, is, do I think prices could fall in the winter? I think prices will continue to moderate. Fall, not the right verb that I would use. I would say move sideways, maybe slightly down. And a lot of it has to do with, just like you said, rates. If we see rates go back down, I think there's less of that. If rates go up from here, you see more of that. But I think if you're waiting to purchase in the fall versus now, sure, why not? I mean, it's all about finding the right property. There's not a lot of property on the market now, so maybe the fall you're going to get some. But what I'll tell you is, typically this is the time of year when you see the most inventory. So if you're not seeing it on the market in the spring, I bet you I went on first part of this year and said that I thought there was a chance that inventory could continue to rise in the fall, just because I think the market would slow down. I don't know that I still believe that. I think inventory could be a problem all year long, in the sense that it stays relatively low. But I think that will keep prices from dropping too much.
Well, think in terms of that, because that was where the conversation went yesterday, Jeb, is that assume that rates fall to 4%. It brings a bunch of sellers into the market. Cool. We have more supply, but now we have more demand, because 90% of those sellers are now also buyers. Mm-hmm. So I am struggling to see. So will home prices fall again next winter? I struggle to see a formula short of higher interest rates. So higher than the high 6s, somewhere 7% and above for a protracted period of time is what it would take to bring prices down. Because what we've seen is there is a subset of people who can and will buy at those rates. and there is a large set of sellers who will not sell at those rates. So supply demand, both at muted levels, but in balance. So it doesn't really give us a recipe for values to come down. You have to get to a point where those that have to sell at a discount because rates are so high that no one will pay the prices that the homes were previously worth.
And somebody that we both follow, Logan Matashami, Housing Wire, believes that there's often two bottoms in a market, right? A bottom in the number of transactions, the bottom in sales, which he believes that we're pretty close to. But he also believes that there's a second bottom, which is a bottom in prices. And he doesn't think that we've seen the bottom in prices quite yet. So, and I think it's just because of the way some of the data reports and that sort of thing, but it'll be interesting. Nonetheless.
Jeb, I love Logan. He's a smart guy. What I would say is he doesn't transact on a daily basis through borrowers. Neither do you and I. We're not buying and selling houses every day, but we're dealing with buyers, borrowers, and we're seeing that. So someone had pointed out on one of the podcasts, said, oh, this is all anecdotal. Well, we didn't say we're doing a data-based episode. We're saying, what are we seeing now? Not only what are we seeing, what are our friends and compatriots in this business, real estate and mortgage around the country, what are they seeing? And there's areas where it's really slow. There's areas where it's hot and everything's going for over list. So if you look at the media and take this monolithic picture of this is what home prices are doing, you're going to be out of step with what your market is and what you can or can't accomplish in terms of buying a home and discounting a price if possible.
Yeah. Now, and to follow up with, me asking the question of where you guys thought rates needed to get, I mean, a lot of it's between 3 and 5. I would say the majority of people are between 4 to 5. There's people, that believe 3.5 rates have to get there to unlock property. If that's the case, we're going to be in a world of trouble, guys, because I don't know that we're going to see rates that low again anytime soon. But that's just my guess. And then the last part of that question, Josh, Fed continuing to hike the Fed funds rate. Does that have an impact on mortgage rates?
No, it doesn't. We saw today the Fed hiked and mortgage rates improved. What mortgage rates are looking at is current levels of inflation and future expectations for inflation. The market obviously liked that the Fed continued to tighten. They liked what the Fed said about what they're likely to do going forward, which sounds like maybe one more hike and then step aside for the foreseeable future. I think that mortgage rates, the mortgage market expectation is looking and going, we've probably seen enough tightening. Let's lay back and see what the results are of that tightening. And hopefully we get that. If not after this meeting, after the next meeting, we can get a period of 90, 120 days where we can look at some reports coming in and see, is inflation moderating back to where we want it to be? Is employment easing off and you get closer to a 5% unemployment rate? Not that we want anyone to lose their jobs, but that's a number that takes some of the wage pressures away that the Fed is worried about. So I hate to say data dependent, but I think the data is trending in our direction. And I think the Fed has bought themselves a little bit of time to step back and say, I'm not worried for the next 90 days. I want more data. And what does that mean for mortgage rates? As long as we're not getting hot reports in terms of CPI, PCE, unemployment, I don't think we're going to see rates go up. I don't know that we see them improve a lot until we see a significant improvement in those figures, but I also don't see them getting worse absent some hot reports.
Good stuff. One thing Josh mentioned it a moment ago, I didn't feel like it was super clear, so I'm just going to restate it. We did an episode that was posted today. If you go to One Rental at a Time YouTube channel, there's an episode where Josh and I were interviewed about the market, about the podcast. I think it's a great conversation. It was a quick episode. So go over to his channel and check that out. It's worth exploring. And again, the conversation that we had with him will actually show up on our podcast next week. And that's really around the idea of investing in real estate. So if you have questions around investing in real estate at all, it's a really good episode to kind of get your teeth into something. That didn't really make any sense.
Jeb, to tease that content a little bit,
yeah.
What I loved about it is we talk a lot about it on the show. People say, well, hey, California, I can't get cash flow, so I'm looking in these out-of-state markets. Michael rightfully points out that he lives in the Silicon Valley, invests in Fresno. We have lots of good markets in the Central Valley, in Bakersfield, Fresno, Tulare, Visalia, all of those areas where cash flow makes a lot more sense. He made some really good points in there. I won't steal his thunder. I'll make you guys go listen to it.
Yeah, good stuff. So go check that out, guys. All right, next question. Anya asked about developments in 40-year mortgages. Is it still only for loan modifications? Yes. In fact, I recorded a video yesterday on this topic because we get it so much. Probably be posted sometime next week. So just be on the lookout for it. I go over it, but no new development. And in that video, I talk about why and why you're not likely to see it. So hopefully that is helpful for you guys. Okay, we're done. There's no more questions. We're out.
We got a lot of answers of what rate it's going to take to bring sellers to the market.
Well, we'll come to those in just a moment. Kim's got a question. Kim is a big supporter of the channel, said she loved the mortgage insurance episode. So thanks, Kim, for all the support. But says property like the one near to me in La Habra. Okay, that I'm missing part of the question. Where's the rest of the question? Here we go. Do we have?
There was a big sinkhole in La Habra, and so she's asking, do you sue the city or you sue the HOA?
If it's in the HOA, if it's in the community, I think it's probably the HOA's responsibility, would be my guess. Outside of the community, it's the city's responsibility, right? If it's on a city street, like in the community that I live in, we have an HOA, but the HOA is responsible for those streets inside the community, and therefore that's an HOA problem. Some communities, the streets inside are city streets. And if it's a city street and if it happened on a street, then it would be a city problem. Like there was a sinkhole in San Clemente on the 5 freeway, for God's sakes. That's a city problem, right? But I don't know if it's about suing the HOA or the HOA just stepping up and taking responsibility and doing what is necessary in order to get it done. Not everything's a lawsuit.
But most times it is a lawsuit.
Yeah, no, but understood.
And the fun part, Jeb, about the lawsuit that I learned the hard way this week is what attorneys do is they look at anyone who can have culpability. If they have more than 2 cents to their name, they get named in the lawsuit. I have a client where thankfully the lawsuit just got dismissed. They were buying a condominium and a landlord was sued 5 years ago by a tenant. It's been ongoing for 5 years. Dispute over whether the mold was caused by the tenant or the tenant suffered from the mold inflicted upon them by the landlord. And literally it took 5 years and the HOA got dragged into this, even though it had nothing to do with the construction or the property. Made some difficult headaches for us here in our process of getting their loan closed. So long way of saying, I think the answer to that question is everyone's getting sued, and then they can go to court and appeal to get separated from the suit if they don't have any liability.
Yeah, it's pretty ridiculous how that whole thing works, but nevertheless. Jessica asked a different question. When does the summer season end? So August is typically when the kids start going back to school here in California. That's, sometime between August and September, but August is typically when you see the peak in inventory, July, August, and then it starts to kind of go down from there. This year will be interesting. A lot of it has to do with interest rates. World Trekker says, if I add to the house $100,000 renovation and sell it in 5 years, would that be a good move? I'm in Orange County, great location. It's hard to say without knowing the house. We've talked about this before. Depends on what kind of renovation you're doing. If you're adding square footage, that sort of thing, that typically pays off. Kitchen remodels, bathroom remodels are all great things. Depends on what if you have a nice house now, and you're just doing remodels for cosmetic reasons because you like your taste better than what is there. Are you going to get your money back in 5 years? Hard to say. You're never going to get dollar for dollar, cost benefit in adding to a house or doing renovations to a house, typically speaking. But a good way to do it is find similar properties in your neighborhood that have the improvements that you're looking to add to your home, and see how much more are they selling than your property selling with those types of upgrades. That gives you a really good indication as to what your property is worth by adding those things. But again, it's hard to say what the market looks like in 5 years. If I had to guess, I would say that prices are higher than they are now in 5 years. But does that mean you're going to get a significant more amount of money for your property in 5 years? Nah, too hard to say. Too hard to say. What do we got, Josh?
Jeb, answer this one, Jeb. I want your take on this. Wesley actually has a good question. Isn't suing the HOA basically suing yourself?
1,000%. Absolutely. So I live in a community that had 5 swimming pools. Actually had 7 at one point. A big, large pool plus 6 satellite pools. 2 of them, the HOA decided, this was years ago, this was 12 years ago, decided that without HOA approval, they were just going to close 2 pools, fill them in with dirt, take them out. And that's against the CCNRs. You can't remove amenities from a community without the community voting on it. So that was problem 1. Then there became a conversation about them removing another pool. Well, then a neighbor got involved, and the neighbor sued the homeowner in the community sued the HOA. He lived in the community. He was an attorney. He sued the HOA. This is now a Supreme Court case. This is, if you are involved in an HOA lawsuit, this is the case that they're going to reference. It's something versus Wittenberg, something along those lines. Anyhow, it was deemed that the HOA didn't have the authority rather to remove those items without the community voting on it. This was an ongoing battle for, I don't know, 2 or 3 years. Cost the HOA $1 million, maybe $1.5 million plus his attorney fees in this deal, or maybe $1.5 million included it. It was a big amount. It was over $1 million that came out of the HOA reserves in order to do this. So he sued his association and won, but at the end of the day, everybody lost because it came out of reserves. Fortunately, there were no assessments or anything crazy in the community. But if you were under reserved in a community, didn't have the proper, funds in place, that could be a big problem. So yes, the easy answer is yes. Yes, it is suing yourself.
Jeb, let's stay on the topic of HOAs here. Orange Pulp says, can an HOA just change the rules to disallow renting out of your condo, thinking of buying for cash flow? And that's a big concern. This would kind of fall back under the same question you just answered. Can they change the rules without the owners, in effect, owners of the HOA, the members of the association voting on that?
No, things like that, it changes to like bylaws of the community have to be voted on by the community. The board has the authority to vote on certain things. Now, I guess it all depends on how the original CCNRs for that community were written. But the communities that I'm aware of require a majority vote. Some of them require not only a majority of the voting members, but it has to be a certain percentage of the community actually has to vote. And if that number of the community doesn't vote, then you don't even tally the votes, right? Because you didn't get enough of the people to vote to start with. But typically the community has to vote on it, and it has to be approved in order for that to take place. Anytime you're changing like rental laws, whether it's, you can't rent your property, how long you can rent a property for, any of that stuff needs to be determined by the community as a whole, because it could affect people who bought in there for a particular reason, right? And so the community as a whole has to approve or disapprove it, for that matter.
We've got a comment here, Jeb, that I would like to comment back to. Salitha, here most every week, has some good comments, good questions. Says normal rates before the government went stupid was around 5%. Not actually true. Somewhere between 4 and 5% has been the historical average. We've had periods well above that. Late 70s, early 80s ran above that. Before COVID, we were in the low 4s. Rates were really good. We had a period in 2018 where the Fed was tightening, and we had run up to about 5%. Less well-qualified borrowers were in the low 5s. But for the most part, that 4.25, 4.75, maybe up to 5 is what the long-term normal is. So does that mean we're going to be there going forward? Does it mean that we don't go below that? Does it mean that it has to have Fed intervention? The thing is, or not just Fed intervention, government intervention. The thing that's so hard to say is our market has been manipulated for so long that it's hard to say what normal is or what real is, or if they can ever truly take the punch bowl away permanently and let the sort of market forces come back into play.
Good information there. I just saw a good question and I lost it. Where was it? As we find it, or as I find it, we'll come back to it. But it says, World Trekker has another question. Says, what do you think of ADUs? Would it help appreciation of my home? I have $100,000 to deploy. Should I pay off my mortgage? I have a 2.5% interest rate. So I'll answer the second part of the question first. So if
the easy part,
if I had $100,000 to deploy, I wouldn't be paying off my 2.5% interest rate personally. I like leverage. I like the tax benefits from a mortgage. I like certain things that a mortgage, allows you to do. And I like capital. I like cash. I like being able to have money to do things if the opportunity presents itself. So that's a whole different conversation. And that's not the right answer for everyone. I want to be clear, right? If your goal is to pay off your mortgage, hey, in a quicker time frame, then by all means do that. But it's just not what I'm trying to do. What do I think about ADUs? I think ADUs are great opportunities to add value to your home. It's very tough to say what value they add because there's not a lot of properties to compare them to in many cases. And I would say, I think you might have a difficult time getting an ADU for $100,000, quite frankly. I think that's on the low side. Even if you were doing a smaller ADU, it's expensive to build these properties. And if you're trying to build it in Huntington Beach, guess what? They're not going to approve it. In fact, they're not even going to look at your application because instead of going along with the state, we've decided to sue the state and say, we're not participating in your funny little game of ADUs. In fact, we're not even going to review applications. So that'll be interesting to see how that plays out. That's a whole different conversation in Huntington Beach about ADUs. But I like the idea of ADUs, but I think they need to be done correctly. I think they need to be done on larger lots. If you have, a 6,000 square foot lot and you're adding a big ass ADU in the backyard, I wouldn't like that as a buyer. But to each his own. So I think for each, again, it's one of those things, to each his own. For some people it's going to be the right move, and for others, not so much.
Jeb, I want to throw some number context on you. The answer that you gave to the second part of the question: 100,000 to deploy. Should I just pay off my mortgage at 2.5% interest? If inflation is at 6% right now, you are actually at a negative 3.5% rate on that. They're paying you to have that money available to deploy other ways. So people hear that and they go, I don't understand. What does that mean? Why is it better for me to have that debt that I have locked in at that super low rate? The easiest way I can explain it, let's say instead of paying it off, you took that $100,000 and you buy a 10-year treasury as of today, the yield on the 10-year treasury is 3.5%. So you're going to have a 1% positive differential for the next 10 years. You could take the interest that the US government is paying you at 3.5%, pay your 2.5% interest, and keep the extra percent for yourself. Now, is that a lot? Is it a huge difference? It's $1,000 positive a year. If we're talking 1% over the course of an entire year on $100,000, but it's just an example. That's one of the safest investments you could make, and it would make you $10,000 over the next 10 years. So that's why we say, don't pay off your mortgage if you have it at that low rate, because you can make some very, very safe investments that will get you a yield in excess of the 2.5%.
I like that. Nick comes through saying, thanks for all your advice from YouTube videos. Closed escrow last week on a house in San Marcos, San Diego. For those of you who aren't familiar with California real estate, never thought it was possible moving here 10 years ago. So congrats to you, Nick. It's awesome, man. So appreciate the support. Appreciate you showing back up. Even though you've closed, that's fantastic. And glad we could be a very small part of the process. Really about educating and letting you guys make your own decisions. I think that's something that we talked about in that episode of what on the One Rental at a Time channel. Is our goal here, guys, isn't to get you to buy a house. But Josh and I, don't let this sound come off the wrong way. We don't necessarily care if you buy a house. We want want you to own real estate if you want to own real estate. The goal here is to educate you so that you can make the right decisions for yourself when it's the right time in your life. That's really what the channel is about. It's not about, hey, you need to go buy a house today because otherwise, you're going to get left behind or you're never going to be able to afford a house. It's none of that is what we're pushing. We're pushing education. And with that education, you're making better decisions. So we appreciate you, Nick. And thanks again for the support. Josh, we got some other questions. Do we have any other questions?
Well, I've got a comment here, and I kind of like the comment, and you give your feedback on it. So Tammy says, never getting rid of my 2.6% loan. I'll turn to a rental before selling. And let me throw this thought out at you and react to it, Jeb. I have that rental in Orange at 3.25%. I don't love that property. It's a nice property. I'm happy to have it. It's positive cash flow. It's a good property. Like literally after the renovation and the refinance, we talk about buy, rehab, refinance, rent it out. I have no money tied up in that property and it brings in about $500 a month. So a good rental, but I also have no love or affection for that property. And there are other things that I could say, well, this would be a better deal, or maybe I should do that. And then I look at it and I go, two things. For us in California, my property taxes are based off of the 500,000 I paid for it versus the 900,000 that it's worth. And I've got a 3.125 interest rate on that rental property. And I go, I don't think that would be the smartest thing to do, to give up either one of those. And I think it's sort of a overlooked thing in terms of additional supply of even owners of rental properties are kind of locked in to the properties that they own right now.
No, I mean, my reaction is, yeah, I mean, California real estate is a special thing in the sense that I think long term it will always perform better than most markets out there. And I even tell people, that are thinking of moving out of state, don't sell your California real estate. If you don't have to, keep it. Just turn it into a rental, go live somewhere else. Make sure you want to be there. And if at some point in your life you determine you're never coming back to California, great, sell it. But the barrier to entry to come into California is so high that it's very difficult for a lot of people to make that step. And so when you tell me that, I think if you could get an opportunity that you were, because that property is basically brand new inside. So can you go get a brand new property with better cash flow, less skin in the game than what you have? And if the answer is yes, newer and other factors involved, then maybe it's something you do. Otherwise, I don't know. I mean, we know rents in California are going to continue to go up long term. What gets you to sell that property? I don't know the answer. I think it's got to be something more than what you're seeing at the moment. And I don't know. I don't see a recipe, but
Jeb, here's a funny comment, and this will tell you that we are not in a crashing market. One of the comments here: how big is that place? You looking to sell? It's a thought. We've had the thought. We're probably not a serious seller before the reasons. Lock in just like everyone else has. If I had something else awesome to go into, if I had another buy that was as good as that one when we got it, where we could kind of parlay it into something else, but it's going to take something pretty sweet to get us out of that, even though I don't have much love for the property. I mean, I don't dislike it, but it's not anything emotional that I'm attached to.
This question: any chance the crazy California weather is slowing down new listings? I could see that being a problem in some of the second home markets, Tahoe, Mammoth, Big Bear, where these places are literally, you can't list a home right now, probably just because of the amount of snow they have.
See it.
Yeah. So that's keeping some property off the market in those areas. I would think. How much? Hard to say. Here locally, we've seen more rain in the last year, and I'm not I might be exaggerating, but I'm literally doing this with no facts. I'm just stating we've got more rain in the last year than we probably have in 20 years of me being in California. 1 year. I mean, it's incredible the amount of rain. And for most places, they're like, dude, that's not even a lot of rain. We live in a desert, people, so we don't get a lot of rain. So, the fact that it's rained for the last 3 days on and off, that's a lot of rain in a normal year. This year, it's like, my God, please stop. So is it keeping some property from coming to the market? I don't think so locally. I mean, I delayed pictures on a property on a new listing until tomorrow because I didn't want to have to take them when it was raining, but we weren't listing, if we had to list it, we would have listed it. So I don't think so, except for in the second home markets, but some people might be holding off until it's prettier outside to get things done and have people walk through.
He answered the question for you. It hasn't been this bad since the 97 El Nino.
And I wasn't here. But I want somebody to add the total rainfall from 2002, when I came to California, through 2022, get the total amount. And then I want compared to the rain that we got in, I guess can't do it through 2022 through now.
I think I saw, Jeb, I saw the number last night. It was in an article for the LA Civic Center, said they have got more year to date at the LA Civic Center than they've had cumulatively since 2017.
Okay. Since 2017. So that's not nearly as long as I like to think in my head, but it feels like a lot of rain. So anyway, enough complaining. Right.
Jeb, I've got another comment. I'm liking the comments as much as the
Yeah.
questions tonight. Monica says we were quoted $250,000 for a $700 or 700 square foot ADU in Norco. If you're doing math at home, that's almost $400 a square foot.
I'm not surprised by
So
that at
I'm not
all. Like,
surprised by it, but it is also batshit crazy. There are
oh, it is.
contractors out there that are saying, make me an offer I can't refuse. Tell me
Listen,
you'll actually pay me this to build you that.
so you say, so the comment you just made there is $400 a square foot. If I wanted to do the addition on my house that only adds just over 100 square feet, Josh, that's going to cost me almost $1,000 a foot. That is insane. Absolutely insane. I mean, yeah. And
Part of that
so,
is the scale of the job. Some of those things are fixed costs. The smaller
right.
your job, you're going to pay a higher price per foot. But Jeb, I can one up you. I don't know if you saw this. For those of you outside of California, or maybe government is crazy everywhere. Did you happen to see that the California government is converting or gave a grant or a bond program to convert a Motel 6 over in Costa Mesa
Mhm.
into low income housing?
But that's only short term. It's I don't think it's permanent.
No, it is.
I
There's
saw,
they
I saw
they
for a year.
converted it. Okay, so I know it's not like a month or 2 months. It may be
No, no.
transitional,
Yeah,
but
yeah.
here's the important part. The rooms are going to be 320 square feet, studio, kitchenette, bathroom, and a place to lay your head. These wizards spent $1,700 a square foot to convert these. The cost per door is $550,000 a door for 320 square foot studios. If you could find one in Orange County, you wouldn't have to pay that much. And certainly not when it's a converted Motel 6 that you have a parking space out front. But
Yeah.
that's our government money at work there. They spent 40 something million dollars to make 88 studios, and they wonder why people don't want to pay their taxes and trust the government to solve problems like homelessness.
Well, hey guys, welcome to the Educated Home Buyer. No, in all seriousness, yeah, and the location's not that great either. Big G says, do you think the fact that California is losing population will cause housing markets to drop? If not, then is California becoming a rich people state? No, I don't think the population is going to cause housing prices to drop. We've talked about this before. California is the third largest economy in the world, third or fourth. I've seen third, I've seen fourth. Either way, third or fourth largest economy in the world. People leave California every day. But the net number is a lot less than obviously a lot of the numbers that reported. So people leave. There's also people that come into the state. Regardless, the net is a negative. But there's just too many people here, guys. I would love to see half of the people in California leave. But that's not going to happen. And, there's still a lot of people that want to be homeowners here, a lot of people moving in that will be homeowners at some point in the future. There's no shortage of people wanting to own real estate, like we say all the time. So I don't see a world in which enough people could leave that actually affected the population here. Now, what could do it is if they started doing something crazy to Prop 13 or the tax bases here, that could drive enough people out of the state to have an impact on house prices. But I don't think that's in the cards anytime soon.
From the numbers that I've seen, Jeb, the majority of people leaving the state are either very low income, where it is awful and very difficult to live in California,
Or very high.
or no. Well, yes, there's a subset of really, really rich people, but middle to lower middle class folks who, if they leave the state, they can buy housing. So they're leaving for a better life from that perspective. So Jeb, Salitha asked very nicely that we get back to her question because we overlooked it, and she's here every week and has good comments. So we're going to answer it. Have the option to permanently buy down my rate. Jeb, go ahead and laugh. I'm using NACA, and
Hey,
we
listen.
wouldn't laugh if you get it. What we want to do, we would like you
I
to
want
reach
to
out to us.
interview you.
I want to make a video. I want to make an interview video if you successfully close with NACA, because you will be a purple unicorn. I know it happens. I just have not met one. So I guess that's a purple unicorn. I don't know it actually exists, even though I've never met one. So if you get it done, please let us know. But their interest rate is 5.5% today. I'm in California. Do I buy down or use money for something else?
How much money is it costing you to buy down the rate, and where are you buying it down to? If their rate's 5.5, what are you buying it down to? How much is it costing you to do it? Where's that money coming from? Is it your money, or is it NACA's money, or is it the seller's money? There's a couple questions there. So answer those questions, and then let's come back to the question again. How's that? I think that's the right way to approach that.
Yeah, and just to put it in context, a general rule of thumb is to pay 1 point will lower your rate 0.25%. We've talked about rate sheets have been really wonky for the last year and a half. So it could be worse than that. It could be much better than that. So how many points are you paying and how much lower is it lowering the rate? And just like Jeb said, who's paying for it? So shoot us those answers. We'll come back to it.
There you go. Gen X50 says, happy hump day. Is it normal that we still have not received our supplemental tax bill until now? We've been at new construction home for a little over a year now. Thanks, Jeb and Josh. Yeah, with new construction, it can take a while, just because, and depending on the location, the city, all of that stuff, how backed up they are in doing tax bills. So you're going to get it. No rush. I mean, let's be honest, like, why rush to get it? So just hang tight. It'll come. But I don't think it's out of the norm that you haven't gotten it. Josh, what do you think about SoCal coastal real estate?
They're not making any more of it. And so unless our state government makes them ruin all of our coastal cities by offering ultra affordable housing, which it's funny, our government, and it's not unique to California, but the California government is special. They think that you can mandate housing affordability. There's only one way to do it, to create more of it. We don't have open land in Huntington Beach. You had mentioned earlier, for those of you around the country, the state of California is actually suing the city that Jeb and I live in because they're not cooperating with their silly ideas of they need to help with affordable housing. So in a city where our average home price is $1.2 million, Jeb, is that what it is?
Yeah, $1,260,000, something like that.
And
Yeah.
we have no land to build additional property. They want us to build, the number, Jeb, is absurd. It's like 14,000, 16,000 units of affordable housing.
No, it's like 28,000. I forget.
So
I'm drawing a blank. Yeah, I don't
we
remember
literally have no land, and there are enough people that want to live here that the home prices are high. It's not nearly as high as Beverly Hills or Newport Beach or some of that stuff, but the state says you need to do your part so that we can house people in affordable housing. It ignores the market that Huntington Beach, Newport Beach, Beverly Hills, these areas are expensive for a reason. There's a finite supply of land and there's an unlimited demand of people who are willing to pay more and more for it. The only way to meet their objectives is to make high-rise, dense housing that no one wants to live in, mind you. Urban areas like Chicago and New York have been dozing their dense, high-rise, low-cost public assistance housing because it doesn't work. It's bad. It's terrible. But long way of saying, do I think SoCal will keep appreciating the coastal areas? Absolutely, because that's where people want to live. So the folks who find themselves in a situation where they have a lot of income, they go coastal. I mean, we've seen, I've told you guys, I have a heat map somewhere that showed over like 15 years from 1985 through 2000, what happens in different waves of prices. The prices go up first in the coastal areas and come down last in the coastal areas, and they move the most upward. So nothing's going to change that. It is simply supply and demand. How much coastal land is there left in the United States, period, but definitely in Southern California.
There you go. Yoshel says, what do you think is going to happen with the California Dream for All loan program coming on Monday? So I actually did a video on that program, comes out Friday. So go into detail more about it, give my thoughts on it. So check out that video on Friday. It will be out there talking about California Dream for All. And for those of you who have no idea what I'm talking about, check out that video. It will tell you what I'm talking about. All right. Oh, there we go. That was Grayscale.
I just saw that. I'm like,
Yeah.
wait, huh?
Yeah,
All
there
right.
we go.
That makes
right.
more sense.
There we go. Let's go. What does the Fed? Okay, I saw a question a moment ago about. Oh, here we go. Rick Harrington. California has a lot of tech jobs. What happens to all those big buildings with work from home and layoffs or sending jobs to India? So, Josh, any thoughts on commercial real estate? I mean, the work from home thing is something that is going to correct itself over time, I believe. You will still get people that that want to work from home. Companies will allow it. I think it'll be more of a hybrid model. So, buildings aren't going to be empty. More and more people over time will require workers to come back to the office. It's been proven that people are more productive in an office. So I think the majority of companies want people to come in. Layoffs, sending jobs to India. What are your thoughts on this sort of thing, Josh?
Well, Chat GPT is the big one here recently, right? How many jobs can be done by that type of AI technology, especially as it improves? There's some truth to that, and we're already seeing that commercial real estate is suffered already. But what are we talking about? What areas? So let's say Silicon Valley, all of those companies, they lose their easy low interest rate venture financing, and they don't need all this office space. We had a comment here. Someone said, "We'll convert office buildings and old shopping malls that no one goes to because they buy everything on Amazon to housing." And there's some truth to that. I mean, for you and I here, the Westminster Mall, like that's not the highest and best use of that land over there. And there are buildings that are already built that are higher density that can be converted. And you're seeing that in other parts of the country. I think that we have needs for space and shelter that it could transition that route, but it'll be interesting seeing. I wouldn't necessarily want to be an owner of commercial real estate right now, just because the questions are big and I don't know that we have any answers yet.
Yeah, and a lot of the banks, that do commercial, bank tightening on that sort of thing is probably going to look a little bit differently with all the banking craziness out there. So, commercial loans might suffer a little bit in those worlds because a lot of it is, the smaller, not smaller type banks, but a lot of the banks that were named in some of the stuff did a lot of commercial type real estate. So, could that see tightening? I don't know, possibly, but nevertheless. We'll be here to watch it if it does. We are, an hour and 10 minutes on. Going to ask that favor that we do every single week and that you hit the thumbs up if you found any value tonight at all. If we've answered your question, you like the show, anything that we've done to improve your experience here, hit that thumbs up. It helps us, helps the YouTube algorithm push it out. And for that, we appreciate you. And if you haven't done so already, listen to the podcast. It's out there on all the platforms. It's also on YouTube, guys. YouTube now has a podcast platform you can listen to through YouTube Music, as Josh mentioned earlier. We also have the videos on the YouTube, the Educated Home Buyer Podcast YouTube page. So go check that out if you haven't done so already. We're close to hitting 500 subs. Can you hit us? Can you help us hit it? Can you help us?
500. We need 500 more. So you guys all run over there.
Well, this channel has almost 80,000. That one has almost 500. So
there's 272 right here. Can't you all just run over and subscribe real quick?
There you go. But you need to watch the videos if you subscribe. Otherwise, it doesn't help.
Yeah, it doesn't help.
But anyway, thank you guys. Let's see. Josh, I saw two questions there I want to address. This one I just clicked on by accident, but let's go with it. My sister has a special needs daughter and gets paid by the government to take care of her. Would buying a house affect her with that? So if she buys a house, does that affect that pay? And can she use that pay to help buy a house, actually?
You can absolutely use the pay to qualify for the home as long as we can show it's likely to continue for 3 years. So permanent disability, permanent special needs, not a problem. Otherwise, if the child's younger than 15 and you get those funds until they're 18, no problem using that income. The only situation I could foresee where buying a home could put this aid at risk is if it's need-based and they do it sort of like student loans, where they're financial aid for students, not student loans, where they're looking at your assets and making it need-based and saying, if you have X amount of home equity, you don't need our help. I don't think it's likely to happen, but that would be the only way I could see it impacting it.
All right. We got Blair Burkhalter. First time we've ever gotten a question like this. Says, we just got my house with the mortgage company my husband works for last month, except he just got laid off. Our first payment isn't even due yet. Should I say anything to them? No, it doesn't matter. Now, if you don't have the ability to pay the loan, then you got a problem, right? You might need to call the servicer and start having that conversation and telling them what happened. But I think it's probably a little early. If you don't need help and you're still able to make the payment, there's no reason to call them. But Josh, what are your thoughts on this?
Yeah, I don't know. There's not a lot you can do about it. It is the reality of the situation. Mortgage companies are having a hard time, and they are absolutely laying people off. So hopefully, he's able to find replacement financing sooner rather than later. And Jeb, we had another question here that sort of comes back to that. Ricardo says, "What do you think about mortgage protection programs in the event of untimely death or job loss? I'm getting solicitations lately. Best bet against the unforeseen future." Remember that insurance companies are for-profit companies. They've run the numbers. They're going to charge you a small amount, what looks like a small amount to you, and they're going to pay
Mhm.
out less in benefits over time, and they're going to make a profit. Your best bet is to save and invest wisely so that if one of those things happens, that you are taken care of. Now, the untimely death is a different animal altogether because if you die, it's not, hey, I need some money to get by for the next 3 to 6 months while I get another job or a better job. It's I'm gone. Are there people depending on my income? Both Jeb and I have life insurance that if something happens to us, my wife doesn't have to worry about replacing my income. She's going to get it. Now, I watch a lot of Dateline in 48 Hours, so it does worry me that she may decide that I'm worth more dead to her than alive, but it keeps me on my toes. So I like life
You're
insurance.
so slow, dude. You'd be taken out in a second.
I like life insurance. Life insurance is important. I wouldn't get mortgage specific life insurance because it's expensive and they only pay off your mortgage. Your family may decide that it's more important to have the lump sum. You can get disability insurance. You can get unemployment insurance. They're expensive. If you're able to save and invest, I would basically self-insure.
There you go. Good stuff. The flight simulation experience is, how do you guys deal with living in that state? I'm born and raised in California, lived there for 38 years, left 15 months ago, and it was the best decision of my life. You know, the easiest way to not worry about living in California is to not get caught up in everything going on around you. Live your life, do your job, spend time with your kids, have fun, and don't get caught up in the politics. That's, I mean, honestly, it sounds like cliche, but I don't worry about what I can't control. So I don't worry about what Newsom is doing in Sacramento, or, unless it directly affects me in my day to day, I don't concern myself with it. And I know that's like put your head in the sand, but it's the reality. I can't control it. So I could sit here and say all this sucks. The state, charges way too much in taxes, but I live here for the weather. And right now the weather's pissing me off. So a lot like you, I
So
might
you're
be gone
considering
if
moving.
this continues. But as long as the weather gets back to what it normally is, I'm happy, man. I don't have any complaints about the politics in California because I don't get caught up in it. I don't agree with them, but I also don't sit here and stress myself out about it. Josh, what are your thoughts? Why do you live here?
Well, I always tell people, if you have the tracking turned on your phone, and so Google sends you every month like the little map of where you went, and mine looks like this. I go like places in a little triangle every day within like a 1.5 mile radius. So where I live, I enjoy it until they make us build 24,000 units of affordable housing in our city that we don't have room for. I'm going to continue enjoying living near the beach, being able to walk out on the wetlands, being able to I drive by the beach. I don't ever go to the beach. I don't like sand. Jeb and his kids actually go get in the cold, salty water. I just look at it because it's pretty. But
It's not even
when you
pretty.
what I tell everyone is everything bad that people tell you about California is 100% true. Everything good that people tell you about California is 200% true. So that's why I'm still here.
There you go. James has a good question. Says, if my house is already paid off, is it a good time to sell to downsize? I say not necessarily. Do you need to downsize? Can you find what you're looking for in downsizing? Are you able to take, taxes? I mean, there's a lot that goes into that question. Downsizing doesn't necessarily mean you're going to be saving any money in some cases because, maybe your property taxes are going up based off where you bought your property now. Maybe you can take them. I mean, there's a lot going in there. So I don't think downsizing is always necessarily the right answer. If it improves your quality of life, the payment makes sense to you, or you're not incurring any additional cost. You're not having to pay capital gains on selling that property for any reason. If you got more there, there's a lot going into it. So it's not as simple as yes or no. It's something you may consider, but I don't necessarily think it's always the right answer. Anything you want to add on that?
No, it's just there's costs to selling. So there better be a
Yeah.
pretty significant benefit if you're going to save on taxes, save on homeowners insurance, save on
Yeah,
heating
I
and
mean, we didn't even talk
cooling and
about
all
that.
that
The
stuff.
the cost to sell, right? I mean, there's cost. It's going to cost you to sell that property. And not necessarily in taxes, but in real estate fees and escrow fees and title fees. And, so if you don't have to do it, why do it? And that's a again a reason that we're in this position now is because there's a lot of people out there that don't need to do it for one reason or another, and therefore that property stays off the market. Did we ever get our follow up from?
I don't think so. I didn't see
No,
it.
no,
She
she
might
did.
have left.
She just
She
bailed
asked nicely for us to answer the question and then
and just
concluded we
bailed.
weren't going to and took off. There is a trick question here for us to answer, Jeb.
All right.
Um, Pupusas or tacos?
What
I
is
don't know what a pupusa is. I've never had one or even seen or heard one. Tacos are amazing. I was fortunate enough to be invited to a birthday party last night with a taco guy. And for those of you that don't live in California, or I'm sure Florida, other parts of the Southwest, where you can have a party and there'll be a guy with a cart with a full-blown taco making setup that will come make the best tacos ever. And you can just eat all night, just taco after taco. It was
Dude, I'm really
fantastic.
getting high. That's like, I'm salivating over here thinking about tacos. Yeah. And then Kim's coming in and saying it's weather, weed, and women that keep people in California.
Oh, Kim,
That's
spicy,
like, sounds like Tupac.
spicy.
That's like a
Yeah.
Tupac line.
This was 2 weeks after she told us she was shacking up with two men, but then she did say one of them's her son.
Too good. All right. What do we got here? What have we? So this question came up earlier from Aaron. You can apply this question, so don't take it literal. When we ask it, if you're in this position where you have to lock a rate and or considering locking a rate, use this as kind of your lead into that question, saying, my family and I are currently having to move to the Austin area due to work. We are closing this November. Should we lock the rate today or wait? Their example is 30 days before closing, but just wait. Should you lock the rate today or wait if you are, say, 3 months out, 6 months out, 9 months out, Josh?
At this point in time, I would absolutely be waiting. If you go back to the first part of the show when we showed the candlestick charts of where we're looking, we're trying to break through a level of resistance to higher bond prices, lower bond yields. It looks like there's a good chance in the coming weeks we break through the 200-day moving average. 200-day moving average is a good intermediate to longer term indicator that things are better and going to be better moving forward. So I would be cautiously floating, but I would be floating. I would keep a very close eye on it. Hopefully your loan officer can advise you on this. Hopefully they're cool with you shooting a text or an email saying, hey, what's the market doing today, this week? What are you advising? What are you thinking? A lot of loan officers, just easy to say, well, let's just lock it, because they don't know or they don't have an idea of what's happening or what's likely to come. Right now, I think the odds of rates being lower when you go to close are much better than them being higher, but there's that risk. So you would definitely want to keep an eye on it. You wouldn't just put your head in the sand for 60 days and come back and go, hey, what are rates doing?
No, good stuff. Something I wanted to throw out there. This is a long shot, but Josh and I are looking to buy property, pay cash. So if you're in Southern California, you know somebody that has a property that is distressed. Maybe it's not distressed. They just need to sell for one reason or another, need a cash offer. Think of Josh and I. Reach out. Maybe there's something there that could benefit you in making a referral, if you will. So keep us in mind if you come across anybody. I just thought I would throw it out there. I was thinking about it in my head and thought it was worth putting out there. Anyhow, Al says, hi guys, do you answer landlord questions? I'm wondering if this is finally a decent time to buy houses and 1 to 4 units in LA and OC for investment purposes. Yes, we always answer landlord questions. And the answer is no, absolutely not. Buying property in
the exact
LA
opposite of, is this a good time?
There's just, I don't see any opportunities where 1 to 4 units in LA and OC make sense unless you can get them off market somehow. Everything I see on the market is, I mean, they're great for whoever owns them because they probably own them at a price where the cash flow makes sense to them. But when I'm looking at properties today and you're figuring out cap rates, most of them are so low that it's very hard to justify, and they require such a large down payment on those units that I just don't know that it makes sense. Josh and I mentioned earlier in the show, have an episode coming out on The Educated Homebuyer where we talk to Michael Zuber from One Rental at a Time with the idea of investing in markets where it is expensive and trying to find opportunities in the state of California. It's going to be posted next Tuesday on the Educated Homebuyer page, or next Wednesday on the Educated Homebuyer YouTube page, but Tuesday on podcast platforms. Listen to that, because I think that is where I would be striving to invest my money versus trying to look at 1 to 4 units in LA and OC, because I just don't see them, the numbers penciling out quite as well, unless
Well,
you can
Jeb,
get something, again, off
yeah,
market.
let's use an example. I had an opportunity, an off-market property in Anaheim the other month. Probably a 900, low 900 property when it was fully renovated. We could have got it in the low 700s. You're like, hey, that's a $200,000 discount. It was going to take 80 to 100 to put it into good shape. So now we have a renovated property, 100,000 under market. When we ran the numbers at current interest rates, absent putting a large down payment into it, it was going to have a big monthly negative. And that's not unique. That's almost every property. Jeb, you had the off-market property. I looked at it. It made sense as a flip to an owner occupant who wanted to live there once we put it in nice condition. Didn't make an ounce of sense as a rental unless you had another couple $100,000 you wanted to put down on it to bring that payment much, much lower.
No, good stuff. And then Kim says, in the OC, good. I might know someone. Yes, in the OC would be fantastic. The closer, the better. But we're not outside of going outside of the OC. Does that make sense? We're not above going outside of Orange County, if that makes sense. So any opportunity, bring it. We want to see it, and see if the deal makes sense.
Jeb, we talked about my wife a couple times. I'm going to tell you a quick little anecdote about my wife that's awesome. About 15 years ago, she was in a job interview, and I forget what the question was, but her response was, absolutely, I can do that. Nothing is above me. And I said, that is right, wife. Nothing is above you.
That's where we went with it. Sorry, guys. Will cash offers beat out FHA or conventional loans? Let's just go with the first part of the question. Cash offers beat out FHA or conventional loans? I would say typically the answer is yes. And well, again, it comes down to two things. First, price is probably the most important thing to most people. And I can say that in 20 years of experience in real estate, mortgage, people look at price before they look at anything else. Secondly, they look at the type of financing. So if you are the highest offer and you have cash, chances are you're going to win 8 days a week. If you're not the highest offer, but your cash, you have a strong opportunity. But if you're a conventional loan, you got 20% down, you're the highest price, and you're comparing it to a cash offer that's quite a bit less, the conventional loan's probably going to win because it's the higher price. FHA is difficult because, people have a negative connotation about FHA when a lot of it's not true, but it's perception. Perception's reality. People look at things differently. And unless you have somebody that truly understands it and can, guide someone through the process, they're going to believe what they want to believe. So oftentimes FHA is frowned upon when compared to these other loans because of the type of financing, but usually price beats out everything. But what will start to play a factor is when you have a property selling for more than it's worth, or someone thinks it's worth, and then there's a cash offer versus a conventional loan. The cash offer might win in that situation because they don't have to worry about the appraisal. There's, the loan. There's certain things that aren't factored in when it comes to cash, and that's the reason that one can look better on paper than another. So, but at the end of the day, cash is king. Cash. It has its perks, and real estate is one of them. All right, here we go. Milwaukee Wrangler. Sounds like a cowboy. First home buyer. What's that?
They don't have cowboys in Milwaukee. It does sound like a cowboy.
I mean,
I think we had someone that's confused. They were supposed to be
that's their name.
Texas.
Maybe their name is Milwaukee Wrangler. That would be fantastic.
Maybe their name is Walker Texas Ranger.
Could be. Very Chuck Norris-ish. First home buyer from the Midwest, Wisconsin. Average folk in our mid-20s and just want a starter house, less than 200,000. How do you see the supply of homes in the next 2 years? So unfortunately, I don't know the Wisconsin market well enough to be able to guide you on anything. I do know that they have an inventory problem up there because we've had people on the show talk about property up there still, selling above, asking price because they have a lack of supply. I don't know what I think. Just like Southern California, you have an interest rate lock-in effect that's affecting a lot of sellers, keeping them in place. That is not restrictive of just Southern California. That is everywhere in the United States. I mean, Josh and I have talked about this a week ago. 90% of homeowners have an interest rate lower than 5%. 70% have an interest rate lower than 4%. And 50%, nearly 50% of people out there that own a home don't even have a mortgage. So you got to think there's a lot of people that are locked into their homes because of low rates. That means your market too. That means supply is going to be restricted because of that. I don't know what drives more supply other than lower rates. Maybe some building, that sort of thing. But at the moment, the homes at the lower end of price points, 200,000 being one of those price points, is there's just not a lot of building in a lot of markets in that area. Just because people can build more expensive homes and still sell them. And so there's less of that type of building happening, and therefore creates even greater supply constraint issues.
Not only that, Jeb, we talked at the top of the show about median home prices and how those numbers get skewed. They're partly skewed by higher numbers of homes in the 0 to 100,000 and the $100 to $250,000 tiers selling right now. So it's a competitive price. I mean, for us in California, we're like, that doesn't even exist, does it? But in the Midwest, it does. And there are people that can get into nice entry level homes. But folks just like yourself in your mid 20s, you don't want to rent, you want to become a homeowner. And you could be looking at a situation where there's a lot of competition for those affordable entry-level homes.
All right. Good question here for you. Josh says, we're fairly new to the home buying process. If we sell our first home and then buy another, I'm confused. You're new to the home buying process, but you're selling a home, buying another. Maybe this is just a question for future.
Maybe they bought a long time ago.
Yeah. Okay. If we sell our home and then buy another one, what percentage do you recommend for a down payment on the new house? So Josh, is there a certain percentage that you should strive for when buying a house, or, are you believe in leverage or believe in affordability? What's your thought on this?
100%. Jeb, an agent that you referred over to me sent a client over this week, and they recently sold a condo. They have $175,000. They're looking to buy a home, $850,000. And this market is probably going to push up to $9 or $950. But let's say they hit $850,000. The $175,000 would allow them to do 20% down. So we should probably look at that. But then we got to say, do you really want to use all of your money? They were asking about FHA financing, very far end of the spectrum, right? They say at $850,000, we're probably going to get a property that needs a bunch of work. So if we go in, we can do 3.5% down. We have the rest of our $175,000. So there's not a right answer. The question is, how much do you have available? With that amount available, what are the options? What do those options look like? What are you comfortable with in terms of the monthly payment? And does a minimum down payment in raising the payment make you qualify for less where you don't get the home that you want? So it's sort of a balancing act. There's not a right or a wrong answer. It's what are you comfortable with in terms of a monthly payment? What does a smaller down payment allow you to get in purchase price that would maybe limit you to a point where you're not comfortable with the inventory in that price range or the areas that you can buy homes? So there is no rule of thumb. There is no right answer. Everyone's going to answer differently. Jeb's going to answer differently than me, different to someone else, different than you. So you just want to be working with someone who can run through those numbers and help you accurately analyze what all of the options are and help you walk through which decision makes the most sense for you.
All right, good stuff. Eric said there's a ton of homes under 200,000 in Milwaukee. So Eric's a Milwaukee expert. So, hey, listen, sounds like there's property out there for you.
Well, here's the crazy thing, Jeb. Yep. We had someone off the show that I pre-approved that was trying to buy here in California. They bought a rental property. It was, I want to say it was 3 units. They paid $111,000 for it in Milwaukee, and it was bringing in like $2,100 rent. I'm like, give me some of those. But then I got to travel back and forth to Milwaukee, and maybe the snow caves in the roof and things that us Californians are not familiar with.
All right. Speaking of which, when buying distressed properties, what do you look for? Cheap fixes or more expensive fixes versus more expensive fixes to avoid? Yes. Looking for properties that have opportunities, or properties that could cash flow for, I mean, opportunities could be a lot of things, but looking for properties that you can get cash flow out of them, in the current state, looking for properties that you can do a little bit of remodel and fix them up and rent them out and have some cash flow, looking for properties that you can, do some fixes, sell them and make profit. I mean, looking for everything under the sun. I don't think we want to rebuild an entire house from the ground up, but I think everything's fair game. If the numbers make sense, yes, we're interested.
For me, I'm cool with anything. What you have to remember is the more involved the repairs are, the more there is likelihood for cost overrun, for time overruns.
Mhm.
So we're going to need a bigger discount the more significant the issues are. I bought a house in Fullerton. It was 2011, 2012. Literally, the back of the house had sunk like 10 inches. The whole thing had to be jacked up, piers put under the whole thing, and it took probably 3 months before we could even start on the house just to get it raised. And we didn't have certainty on that budget, so you have to account for it. But anything that gets a bigger discount, and not just a bigger absolute discount, a bigger relative discount that leads to more profit, where it chases other people off, other people are afraid of it, those are good things. But you got to be able to quantify it and know what you're looking at going in.
All right, good stuff. Let's see. I'm gonna read this question. I'm trying to read it, but I'm just gonna read it so we can all answer it together. Hey guys, first time buyer, 1099 here, 120,000 total, 650 credit, plus my son makes 42,000. He's a W-2, his first job. On his second month, no credit yet. He's 19. He has his wife as his dependent. Try to buy a $500,000 house or rent. So, Josh, you got somebody that makes basically 120 grand. I don't know. Is the son contributing to the mortgage, or is the son just on the loan for purposes of helping you qualify, even though it's only a second month on the job? So, Josh, I don't know how you want to, if there's
Big
enough here to
thing.
answer.
Yeah, well, there's a big thing that I see when someone says 1099, I make 120,000. You pay taxes on 120,000, or that's what your 1099 says, and then you had $65,000 of expenses that then go down to $54,000 that you're paying taxes on. That's the first question that we have to answer. Analyze the tax return, see what your qualifying income is. Is it 120, or is it some amount less than that? In regards to your son, the thing that I see that scares or worries me, that's a red flag, doesn't mean it's dead, but it means we had to dig deeper into. If he doesn't have credit, we are highly unlikely to get an automated approval. So now we're talking about a manual underwrite. You're going to be limited in your debt to income ratio, and we're probably going to have to show some forms of alternative credit. So hopefully he's had a cell phone for a while, some other type of bill that we can show he does have a positive payment history. Not an easy loan there, but also not an absolute no. So just in terms of the numbers, if I had someone that made 120 with a co-borrower that makes 42, it's $162,000. So is that $14,000 a month? A $500,000 payment is or $500,000 purchase, the payment on that is very reasonable from a debt to income perspective. So the question here is, try to buy the house or rent. Well, what does the mortgage look like if you qualify for it? Can we get you qualified? If so, what does the mortgage look like? How does that compare to renting similar properties? And how much do you want to own right now versus buying? You're here watching our show and you're asking about rent versus own. My gut says you want to own a home. We just need to go through those numbers. Is it possible? And how much more are you paying to own versus renting a similar property?
And one thing we haven't mentioned throughout the show is if you need a lender, need a real estate agent, there's a link scrolling the bottom of the screen. If you go to that website, can refer you to somebody that we know, like, and trust that can answer some of these questions for you, guide you through that process. So be sure to check that out. Josh, we got a lot of questions on construction loans here. A lot, more so than I don't know, like just all of a sudden popped up about construction loans. Like, I don't know what's happening
I
here,
think
but
it's a contagion. One person asked, and then they all wanted to ask the same
so
question.
instead of getting dug deep into that, I'm going to go a different direction, and I'm going to answer a question that Chandler has. Says, I bought another house. Should I rent my house or sell it now? Another one of those questions. Sell it and do what? What are you going to do with the proceeds from that sell? Are you going to put it in the bank? Are you going to buy another piece of real estate? Are you going to pay down your current mortgage? What kind of cash flow can you get from that property by renting it out? Does that cash flow make sense to you? How long do you plan on owning that additional house? If you plan on owning it long term, you're going to miss out on the capital gains exemption there from it being a primary home, which I assume it was, into now being turned over as a rental. So some things you need to think about there on that. I'm a believer that if you can keep real estate and it doesn't change your life and benefits you in some way, cash flow or appreciation, whatever your goals are, keep it. If you need the money for something else that you're doing, then I think the answer is there. So you got to make the right decision. But I think there's some additional questions that you need to be asking.
The easiest way to acquire a rental property is to buy it as your residence and move on and buy another residence. So if you want to acquire a portfolio of properties, keep it. If being a landlord was never part of your financial plan or goals or objectives, or you don't think you're good at it, or even just don't want to do it, then sell the property. But in the interview with Michael Zuber, one of the things he said is, I don't believe you need 10 properties or 100 properties or 1,000 properties in your portfolio to change your life. The number is 4. And for those of you guys that are looking to buy your first home, you get 4. Oh my God, that's miles away. I think everyone watching tonight over a 20-year time frame, 4 homes, 4 properties is an achievable goal. And in this instance, you already have a leg up on that. I would try to hold on to it unless for some reason you don't like that property or have no interest in building a portfolio of properties.
There you go. I'm going to throw out some questions, Josh, about construction loans. You can answer what you know, and we'll go from there. Is it harder to get a construction loan versus purchasing a home? Is the first one. So do you want to answer that?
Yes. For the most
Okay.
part, they're not going to follow automated underwriting.
All right.
Automated underwriting is an easy button. It will allow you to go to higher debt to income ratios. So you're going to require a little bit bigger down payment, probably have some more reserves, probably have to have stronger credit. If you're really well qualified, it's probably not going to make a difference. But if you have marginal qualifications, it may mean you could absolutely qualify for an FHA or a conventional to buy a home, but not qualify for the construction loan. And we've talked about this a million times on the show here, Jeb. If you've never owned a home, I would think twice about building a home as your first property. I have a client right now. I believe he's $300,000 over budget on the renovation of his house. He didn't build it. He bought a house, and he's in the construction industry, by the way. He's a foreman that makes $200 an hour for a construction company, and he went $300,000 over budget. And we're now looking at a very different loan to get him out of what got him into the property. So a long way of saying, if you don't have that level of experience, knowledge, expertise, I just see so much potential for trouble. It's not an easy button. You can't look and go, oh, I can get a lot in my area for $15,000. And the builder says they can build me a 1,500 square foot house for $100 a foot. It's a recipe for trouble.
All right. Any advice on how to find good construction to permanent loans? Are the prices for these loans likely to be affected any more or less than other loans in the current market?
For the most part, the majority of these loans are done by local banks, community banks, and they may choose in the current environment to either stop lending or be more stringent. So it would be more likely to be impacted than your typical Fannie, Freddie, FHA, VA loan. That being said, there are a small, tiny handful of lenders that are doing FHA and VA construction to permanent loans. So they're out there. It is possible. I hate to tell people what to do or to sound negative. I just be very careful going into this space.
There you go. Last one, Josh. How much construction loan can one get for an $82,000 income? What more do you need to know?
1,000 things. The number one thing, I have a guy that reached out here in Southern California. He makes $120,000, and he says, "Well, how much can I afford?" And we start going through it, and he's a $950 car payment. Makes plenty enough money to qualify for what he wanted. When you factor that car payment in, we're about $50,000 to $80,000 short of where he wanted to be. So credit score, down payment, any number of things that we would need to know, other debts. It's not an easy thing to answer. Use the link below. Let's get you connected to a lender who can go through that with you. A lot of times people think if you hit that link, someone's going to sell you. When those inquiries come to me, Jeb, I'm not trying to sell someone on buying a house or getting a loan. First thing we start with is, what questions do you have? Cool. Now, if we're talking one-to-one on the phone and you say, hey, I want to do a construction loan. I make $82,000. How much do I qualify for? I can ask you the 5 or 6 or 7 questions I need to know. We can go back and forth, and we may decide, hey, makes sense. Let's start the pre-approval. We may decide, hey, we're not quite where we need to be. Let's talk again in 6 months or 12 months or 2 months,
Right.
whatever the number may be. So don't feel like this is a sales call you're signing up for. It's a pre-approval consultation to get your questions answered and to determine, does it make sense to move forward in that pre-approval process.
All right. Good stuff. Brandon says spec homes thoughts. They're popping up all over Texas. Spec homes. I mean, I don't have a problem with them. Sometimes they can be great properties. It no different than any other property for that matter. It just comes down to price and how it compares to other sales in that market. I think you're going to see, probably less of them just in the current environment heading forward. But I believe there's probably a lot of them out there in the pipeline that'll be done. I don't have a problem, good or bad, with them. Josh, any thoughts on spec homes?
No, pretty much the same.
Yeah. All right. Good stuff there. Let's see.
There's a good one here, Jeb. We actually have this on the roadmap for the podcast to do a
Mhm.
full episode. Could you please cover the qualifications for a rehab loan? What is needed? Is it similar to a conventional example, looking to buy a home for 400,000 and put 250,000 into it? So some of the programs have limitations on how much rehab there can be, which types of rehabs. There's conventional. FHA also has the 203K. You're probably not a veteran. If you were a veteran, we do have a veteran rehabilitation loan as well. So all of those options exist. It's going to be a little bit tighter underwriting and guidelines than a standard loan. But since it still falls under Fannie, Freddie, FHA, VA, they're relatively easy underwriting. And what you're talking about sounds like it would be doable, assuming that you qualify for the underlying loan.
Good. Anya says, what is a spec home? It's a home built without a buyer, right? So someone builds a home without having a buyer in mind. And that house is now for sale. They built it with the idea of selling it to a potential buyer. That's essentially what a spec home is. RGJ, this is probably the most difficult question to answer, not from the information being able to answer, because it's an easy question to answer, but it's difficult because it's just like you're beating people up because of where affordability is. I live in SoCal, have less than an 800 FICO, $50,000 for a home, and no debt, but I only make $70,000 a year right now. Is owning a home in Corona, Riverside possible area? Is it possible? Yes. Is it the property that you want to live in, that you have your dreams set up to buy? I don't know. It's hard to say. So at $70,000 income, what's that? $6,000 a month, just under $6,000 a month, Josh.
5833.
That gives you high side, 30, depending on how much you have, no debt. So let's say you have $3,000 a month to spend towards a mortgage. In this environment, $50,000 down. I mean, if you were to find a $350,000 home, Josh, you're financing $300,000. What's a payment on that?
So I have a little calculator that helps my assistant with these questions because they come up a lot. So
Yeah.
70,000 tells me 5833 a month. If we went to a 50% debt to income ratio, all allocated to the mortgage payment, that tells us we can go to 2917.
Mm-hmm.
So if we're looking, let's call it 10% down, and if you were able to do some type of really good first-time buyer program that gets you down to about 6.25, what are we looking at? 400,000 would be a little too high on the payment. So you weren't far off, Jeb, somewhere between 350 and 400,000. And he clarified it's over an 800 credit score.
Okay.
The credit score will help you go to the maximum of the guidelines. It's not going to help you exceed that. So the highest we can ever get on a conventional loan is a 50% debt to income ratio with no other debts. And with a higher than 800 credit score, you're likely to be able to get that. But it tells you somewhere between 350 and 400,000 if there's no HOA. So if we had an HOA in there, which in that price range in Corona, you're probably going to have, now we got to take another $50,000 off the purchase.
Here's the thing. Owning a single family, tough. Buying a condo, probably less tough, right? I mean, it's not impossible. I would say so. The answer, is it possible? Yes, it's possible. The problem you have at the moment is just a lack of available inventory. Riverside, Corona maybe has a little bit more, say, than Orange County. But I think there's opportunities out there. Keep saving for down payment. Sounds like your credit's there. Maybe at some point you get married, you have a dual income or the ability to add something to that and get you a little bit more house. But it's possible. It's just on the tougher side.
These conversations are literally the least favorite part of my job right now, because there are a lot
Yeah,
of
because
people
you want to give people good news.
and 3 to 4 years ago, with lower rates, lower prices, this person was buying a nice property.
All right, this is a question. James says, if your house is worth 825, you sell for 1 point. If your house is worth 825 and you sell it for
I think he just meant to
1.1,
say he owes 825 because it
okay.
doesn't make sense otherwise.
Profit about 275. Do I pay capital gains of all the profit or just 25,000? Really depends on your cost basis, right? What did you pay for the house? What improvements have you done to the property during that period of time? And then what are you selling it for? Right. So that it's not how much you owe on the property. It's what did you buy it for? What is your cost basis? Right. Because some people refinance and take cash out. Right. So their loan amount's actually higher than it should be in the how you get to the number. So yeah, does that make sense? That makes sense when I said it. Anyway, you got to figure out what you paid for it, improvements that you've added to that property, and then you figure out what you're going to sell it for, take out the cost to sell. Is that number greater than 250? If so, there's potential taxes. If you're married, it's 500,000 that you have the exemption for. But either way, talk to a CPA, a licensed tax professional. We are not those people, and have that conversation, because they're the people that can really help you with the bottom number, the bottom line, if you will.
Jeb, the two things that you said that we need to put in big bullet points, red letters: what you owe on the property is irrelevant. How much you walk away from escrow with is irrelevant. It's that cost basis that Jeb was talking about. What did you pay for the home? What qualifying improvements did you put into it that may have increased that cost basis? And the difference between that and what you sell for is the important part.
All right, good stuff.
Let's go back. This is an easy one, and let's reiterate here.
Yeah.
Martinelli Arsenal guy says, my wife and I are getting a physician loan at 0 down at 6.7% with no PMI, 7-1 arm, but we will be able to pay it off early after we complete training. House is $500,000. Is this a good rate? This actually wasn't the question I thought I was clicking on, but this is a good question too. Physicians loans are unique. Banks generally are trying to get in early and build relationships with physicians. So they'll do things like ignoring student loans, all that fun stuff. There's a lot of moving parts here, but no down, no mortgage insurance, under 7%. Yeah, it's a good deal. Get it done. Hopefully you have some equity, and 5-10 years from now, you're looking at refinancing to a lower, more permanent fixed rate. But you're early in your career, most likely, you're talking about finishing your training, you have a strong income trajectory. Might there be a better deal out there? There could be, but it's not a bad term at all.
All right. So which one were you going to click on? Because there's a couple here that I was going to click on.
The one right above it. Kimberly Dunn says, plan on pulling from my Edward Jones for the down payment. Want to do at least 10%. Do you think it'd be worth the penalties and taxes to be able to get the mortgage insurance off in 11 years? Do not be afraid of mortgage insurance. Go back and listen to our podcast where we talk about mortgage insurance.
This week. Yeah.
This week.
Just posted. Yep.
Reach out to a loan officer, have them quantify it, have them show it to you. You are much better off in most situations paying mortgage insurance than paying penalties and taxes to pull money out of your account. If it's a retirement account that you can borrow from to avoid the mortgage insurance and you can pay yourself back with interest, no problem. But do not pay penalties and taxes just to avoid mortgage insurance, which for well-qualified borrowers with a decent down payment is pretty minimal.
There you go. On has a question here. She asked this earlier. I meant to click on it, forgot. So thank you for being patient. You mentioned no tightening yet in underwriting for conforming loans. What about jumbo and non-QM like DSCR? Do you see lenders starting to pull out products on those spectrums? So is it getting any tighter on non-conforming loans?
I've seen the only updates I've seen from those lenders over the last week or two since the banking stuff has jumped off is several of them lowering their interest rates. So I've seen the opposite, not loosening guidelines, but improving terms. So from that perspective, I wouldn't read too much into it. You're on the right track. Like my brain would tell me that stuff would be the thing that would fastest and be most likely to see changes and tightening to their guidelines.
Good stuff. Platinum Black has a hilarious question. This physician loan, is there a video game designer loan? No, it's just, physicians, doctors, high income, earners there coming out of college, I guess, and residency get these special perks. So
Jeb, we went over this a few weeks ago. We do have special loans for OnlyFans stars. So fill out the form below, and we'll
submit pictures. Submit pictures.
Submit pictures, and we'll let you know what terms you qualify for.
You're such an old man. I'm going back to that that original comment from John. You old.
You asked me on the podcast 3 weeks ago.
Hilarious.
Well, what about OnlyFans income? Can you use that to qualify?
All right, guys. If you're still here right now, do us a favor, hit that thumbs up. We appreciate all the love and support you guys give us, and it helps the YouTube algorithm. If you haven't listened to the podcast already, go search for The Educated Home Buyer on YouTube podcast, or just watch the videos. You can do that too. You could check us out on Spotify, all these platforms. We're everywhere, guys, everywhere you want to be. And the information's different here. So if you're a home buyer, check it out. Watch us on Zuber's one rental at a time show or podcast or whatever it is over there.
Video game.
Yeah, video game. His channel. Josh, what do you want to say here? Got 274 people on. We've been on an hour and 53 minutes.
If you're here and you're here 2 hours into the show, you want to get educated, you want to make good decisions, just keep showing up, keep asking your questions. For us, it's good. We enjoy seeing new and interesting questions. And if we don't have the answers, we can always go out and research them for you. So just keep thinking what you need to know to make the right decisions for you and your family, and show up here and ask us.
All right.